Rates up globally after a Fed policy statement. Oil prices down and stocks down too. Let's talk about that and more in the context of retirement savings with Ramsey Smith, founder and CEO of ALEX.fyi. Ramsey, welcome back to Real Vision.
Thanks. It's been too long. It's great to be back.
Yeah, very good to talk to you. As you were saying to me right before you got on, we're a macro shop. We care a lot about macro, but we also care about our personal finance. And you're someone who knows a little bit about that, having worked at Goldman with insurance companies, and now founder and CEO of ALEX.fyi. Maybe before we get into what's going on in the markets and how we got to think about our retirement based on that, you can give us a little background on what you do at ALEX.fyi.
So we're a retirement solutions company. We started out focusing on direct-to-consumer distribution of annuities, and it soon became clear that the problems that annuity addresses and the discussion around getting to the right kind of annuity involves a very important planning process. So we're more of a retirement solutions company. Annuities are a core competency, but we're really focusing on helping people answer a broad number of questions. One of which is, how to make the most of what is everybody's first annuity and pension plan, which is Social Security. So that's something that we're going to be adding to the tool mix in the near future.
That is great. And, obviously you're someone who knows markets, having worked at Goldman Sachs for a number of years. You worked with insurance companies, you worked in global markets. Let me just pose the general question. I mean, the lead-in that I gave today was talking about rates going up. In that context, stock prices down. Let's just forget about oil for a second there. A lot of this is due to the fact that the economy in the United States in particular is doing really well. People are expecting a reopening that's going to be very positive for global growth. How are we supposed to be thinking about this in terms of what the range of outcomes are economically and maybe for the markets?
So a few things. So the other thing I'll mention is, yes, I worked at Goldman. I worked very closely with your founder, Raoul Pal, by the way, back in those days. So there's a number of things. I think that the current rise in rates, first of all, as somebody that's in a business that's essentially a spread business, it's good for pretty much every product in the insurance business, whether annuities or life insurance, et cetera. So that's a good thing in the near to medium term. I tend to think that the rise in rates is probably going to be somewhat temporary. My view is that while we're in a period of great stimulus, we're in a period where there are going to be a lot of people, there's a lot of animal spirits that are waiting to come back in the market. I think that those might one, be inflationary in the short term, and two, will potentially lead to higher rates. My view actually over the longer term is one that that most of the forces in the economy are actually more deflationary. So I'm still a believer in the long run that that deflation will rule, and that we may end up seeing the lows in interest rates as well, sort of out once we get past this initial push.
Interesting. So you and your former colleague, Mr. Powell, are pretty much on the same page, because that's very similar to some of the things that I've heard him saying.
Yeah.
The question is, but in the here and now, in the short to medium term, can this rate rise actually turn into something that's bad? And if it can turn into something that's bad, is it something? What is it that's going to happen? Is it the dollar? Is it the actual rates themselves hurting different parts of the stock market or the economy? What happens potentially over the medium term?
Well, I don't know if it hurts the economy. Well, look, higher rates are obviously less accommodative. So in some sense, it will clearly affect the economy. But if I think sort of a bit more locally to sort of specific verticals, I think it will probably have an impact on the housing market. So it may slow down sort of the rate of purchases and refinancings that we've seen. Another vertical that's very interesting to me is the bond market. particularly the companies that are very close to the edge of the investment grade versus junk. All those companies and other companies, will obviously have to pay higher rates to refinance now versus where we were, in the last several months or so, or even years. So, I think those are the issues that I would worry about, is that parts of the economy that are very sort of refinancing driven. So again, certain aspects of the bond market as well as the housing market. That's where I would be worried about sort of a more immediate drag.
So let's take a wider lens then to this, and rather than a wider lens going forward, let's look back, because you and we've spoken a number of times, but the last time that we actually spoke about the annuities business and retirement in general at length, I think was probably before the pandemic. And the pandemic has changed a lot of stuff. I mean, when you are thinking back over the last year, it was a year ago, actually, a year ago in 2 days, that we had this 12% down move, and then the Fed stepped in a year ago. I think it was March the 23rd. I mean, what's changed in your business materially that our listeners, our viewers should be thinking about?
So there are two things that have changed. So one, up until the very recent rise of rates have been going down, which which can create challenges. And again, in a business that's very rate driven. So whether you buy an annuity that's paying a rate of interest, or if you buy an annuity that is providing some kind of exposure to a stock market index, your participation in that index is driven by a hedge budget, which is driven by the yield of the portfolio that backs it. So lower rates were definitely creating a lot of challenges there. So again, I will say that like rates going up is good for the insurance industry, because it allows them to sort of pass more yield onto their customers via the pricing of their products. The other thing that's been happening in the last year or two that's been quite interesting is that there's been a lot of change in ownership in the space. So one of the things that we've seen is a lot of alternative shops either launch businesses that are annuity based or purchase ones that are annuity based. So one example is KKR bought Global Atlantic, which is my former colleagues from Goldman. They used to be the Goldman Sachs Reinsurance Group. They spun out of Goldman. They built a very robust business organically and via acquisition, and they were most recently purchased by KKR. And that's part of a longer term trend that goes back to 2008, 2009. That started with a company called Athene, which I understand is also being merged with its affiliate Apollo. But it goes back to then with this idea that annuity books have real value as sources of permanent capital. And so you saw a first wave of those kinds of acquisitions happening in 08, 09, 2010 back then. And then you're seeing a more recent wave of the same thing in the last few years. And a lot of it's being driven by some of the more sort of famous names in the PE space. So those are a couple of the trends that that I'm certainly keeping my eye on.
Yeah, so let's think about retirement more generally speaking. Okay. I mean, you are someone obviously who was in the insurance space, but when you're thinking about this environment over the last year, what's changed for how you're thinking about people's retirement and whether or not they can get the yield, the return that they're looking for in the various vehicles that are available to them? In particular, let me just talk about the 60/40 portfolio, which, by the way, I don't think annuities are necessarily a part of.
Yeah, so that's a big conversation. Is like where, as you're thinking about, if you're thinking about your portfolio and you look at the traditional 60/40, is there a place for replacing some or all of the fixed income portion of it with some kind of annuity. And there's different ways to handle that. So one simple approach, which is very similar to buying a bond, is buying a multi-year guaranteed annuity, which is again, it's a horrible acronym for a very simple product because it's very similar to, say, like a CD. Right now, if you buy one of those offered by some of the carriers that have some of the lower ratings, they can pay close to high twos or close to 3%. So that to me is actually sort of the easiest implementation because the rates are good relative to obvious alternatives. And they're tax efficient, and beyond that, you don't lose control of your money. So after the guarantee is over, you can take your money back and you can reinvest it elsewhere as you see fit. The annuities that we spent a lot of time discussing last time we were on this show, I was on the show, were annuities that were similar to a pension plan. And they were either immediate annuities or deferred income annuities that where you give a lump sum of money to an insurance carrier, and they make a stream of payments to you for life. And generally, there are some exceptions. There's some riders you can choose. There's some selections, but in its purest form, you're getting back money till the day you die. So if you live to 5 more years, the payments end there. If you live 55 more years, you obviously get your money for a much longer period of time. And those structures, the payouts have suffered a bit. One, just because interest rates had come down up until now. And two, the thing that a lot of people need to get by with those is that once they hand the money over to the insurance company, it's you have to live out your days to get your money back. And so some people are comfortable with that. Other people don't want that. So the multi-year guaranteed annuity is interesting because it looks a lot more like a CD or a bond, and so it's a much more familiar structure of payment. And again, this idea you get your principal back at the end of the guarantee period is also something that's more familiar to most people.
So this whole 2 to 3% number that you were talking about, that's the thing that sticks out to me as you say that.
Yeah.
2 to 3% is not a huge number. What are you going to do with that? Because no one can live off of 2 to 3%. Given the sort of returns that people are expecting, how much are you going to get from equities to compensate that? How much are you going to get from the bond part of your portfolio? Where else do you go? I mean, if you're thinking holistically in terms of your retirement portfolio,
Sure.
what do you do now in the environment that we're in, where yields have come down, even though they're coming up? You're telling me, actually, you know what, disinflation is still there, and likely yields will stay relatively low for the foreseeable future.
I mean, that's my view. That's the long-term trend. So the one thing I'll say up front is, like, I've never posited annuities as a substitute for equity exposure. Quite the contrary. The whole idea behind having a low risk sources of either yield or either yield or straight yield or an income stream that you might get from for example from a immediate annuity that includes yield and what are called mortality credits. The whole idea is to impart stability on your portfolio, so that you've got part of your portfolio that's delivering a guaranteed income that covers your basic expenses, so that you can stay invested in the stock market or elsewhere without having to dip into that principal to cover your expenses in periods of market downdrafts. So that's the goal. By the way, this is not investment advice, because I'm not in the investment business. I'm in the insurance business. But I'm a believer in equity, in the equity markets, and I think they should be an important part of anybody's portfolio. If you're asking me, what my view is for the equity markets in the coming year or two, I can't, I don't have a crystal ball. I think that the liquidity that's coming from the stimulus will be helpful to the markets. I think that the the activity of people coming back into the market from being inside their houses will be coming out into the business world or just going out and enjoying themselves will be should all provide decent tailwinds. At the same time, I see a market that has some things that should be concerning. So there's a lot of the value of the market, a lot of the gains of the market are concentrated in a small number of companies. And then you have these funding issues that I was talking about earlier, which may ultimately end up impacting a lot of the other companies in the market that aren't in the top 5 or 10 technology companies that are dominating that have been dominating the scene.
So let me sort of unpack that
Sure.
and give you a thesis here. So let's forget about 60-40.
Yeah.
Let's talk about bonds, annuities, and equities. First, we know that bonds are returning very low amounts, and potentially, given our conversation, this is going to continue into the future. There's a number that you put out in terms of annuities in the 2 to 3% range. And then we have equities where you can get more returns, where people have traditionally looked to have a larger percentage of their portfolio. But given where valuations are now and some of the things that are actually happening in the market, the longer term, let's call it the 5, 7, 10-year return profile is relatively uncertain there. So if you package all that up together, you're talking about a situation where, just from a retirement perspective, if those are 3 of the pieces of your pie, you're likely to underperform relative to previous performances over the last bull market that we've had.
That's quite possible. I mean, you can only work with what you're given, right? So it's quite possible. If you take the thesis, if I understand you correctly, you're saying you think that you see the expected returns of equity markets being lower for the next 5 to 7 years than they were in the past. Did I get that right?
Well, yeah, I don't know if I would call that my thesis. I'm saying that I'm positing that as an outcome based upon what you were saying about some of the froth that you were pointing to. Yeah.
Well, I think you have to operate under the assumption that's at least a possibility. So I hope the equity markets perform extremely well, but you have to operate under the assumption that it's at least a possibility that after the strong markets that we've had up until with the exception of that moment earlier in 2020, that markets have been overall strong. You have to expect that at some point there are going to be some pullbacks, and in my mind, to the extent that you can build a defensive portfolio that allows you to weather those pullbacks, again, where you have steady income coming from, whether it's from bonds, whether it's from an annuity that's like the MYGA I mentioned, which again is very bond-like in that you get return of principal, or it's from an immediate annuity or from a deferred income annuity that is paying you a fixed amount. And depending on your age, if you were 65, it wouldn't be 3% a year; it would be more like 5 to 6% a year, depending if you're male or female. The key is to build a scaffold, a portfolio that has true low risk sources of guaranteed income, and I count Social Security in there too, that allow you to weather the storm on your risky assets. So another area that's worth everybody taking a closer look at, that it isn't even market related, is to reevaluate where you are on your Social Security planning. Social Security is an extraordinarily valuable source of income. It's an annuity, it's a pension, and virtually everybody has access to it, certainly everybody in the United States. And one of the things that's been enlightening to me is that the difference between a good Social Security claiming strategy, and what I mean by claiming strategy is what you instruct the Social Security Administration to do on your behalf. The difference between a good strategy and a bad strategy can be measured in hundreds of thousands of dollars. So
that's interesting.
Yeah. So in my mind, I I don't view myself as an evangelist for a specific product. I view myself as an evangelist for incorporating low risk guaranteed sources of income, or hopefully guaranteed as close as possible to guaranteed sources of income as part of your retirement portfolio, whether that comes from the government, whether that comes from a pension plan, whether that comes from a privately sourced annuity, whether that comes from a tontine, whether that comes from your Uncle Bob that has a AAA credit rating, right? I want to focus on the basic concept of using that as a tool to lower stress in your retirement and give you the ability to take greater risk elsewhere in your portfolios.
Nice. Yeah, I think that makes a lot of sense. And that's good because then you will be able to take the risk on the equity side. But, going back to the Social
Or
Security
Bitcoin
side,
if you want to. I mean, wherever it is you want to do.
right, right. I
I'm
mean,
not advocating Bitcoin, but that's the.
uh-oh, yeah. Like there are those in our user group who they don't want to hear anything about crypto. So I'm gonna
Really?
have to.
I thought everybody that's in the Real Vision audience wanted to focus on crypto and little else. That's just based on the shows I've seen come across. By the way, I've loved the discussion, so that's okay.
Excellent. Well, everyone, if you're watching this, in the comments, tell us like, how much crypto are you looking for on the non-crypto side? I think it'll be interesting to see what people have to say,
Yeah,
Ramsey.
sure.
But the thing that caught my eye about everything that you said was of those potentially or largely guaranteed options that you have available to you. There were hundreds of thousands of dollars difference between outcomes for Social Security, which is a mainstay within the United States.
Yeah,
How's that possible? To walk us through
sure.
what those differences are.
So let's first talk about what Social Security provides, and it's pretty remarkable. It provides a set of benefits that you really can't source privately, both from a credit risk perspective and actually because of some of the features that are built into it. You can start at age 62 and you can delay as much to age 70, but the basic function is you get a dollar amount. It's based on how much you put in. There's a formula, and I won't get into the specifics, but a formula that determines what your initial payout is at your full retirement age, which for you and me, Ed, is going to be 67. But for somebody that's retiring in the nearer term, it might be 65. You can potentially start collecting money at 62, but you'll get less money. And if you delay to age 70, you'll get more money per month. And there's a few features that are interesting about it. So one is that for every year you delay relative to your full retirement age, the amount you'll get per month goes up by 8%. So that's a big guaranteed bump for delaying, for a year. Like if you have the cash flow available to not take your Social Security and live comfortably up until you eventually take it, you're getting an 8% roll up on your monthly payment. The other thing that you're getting with Social Security is you're getting a cost of living adjustment. And one of the things that I learned in my days when I was still at Goldman, and I still observe here, is that inflation is pure inflation is hard to come by, right? So a lot of people will invest in equities as a proxy for inflation. You can buy tips, but I haven't looked at them lately, but they always generally seem to be relatively expensive to me. There aren't that many ways to efficiently get inflation. I can say that insurance companies can't actually provide it to you efficiently. They can provide you sort of proxies for inflation, but I find those to be a bit expensive. But the government is going to give you a cost of living adjustment every year. It typically averages about 1.5% or so, but it's been much higher in prior environments, obviously. But all those features together are are quite valuable. And so when you look at what if you look at what the differences between somebody, especially a couple, claiming their benefits at age 62 versus delaying to age 70, and then making some optimized decisions about the primary person's claims versus spousal claims, you can actually uncover some really sort of meaningful differences in dollar value. And what's most striking to me, Ed, is that so few people understand this. It's not like these tools haven't been around. So sometimes those tools reside in a book. Sometimes you can read a long book and figure it out. You can use software, and we're going to be providing that software on our website in the relatively near future. Or you can hire a Social Security advisor that can walk you through it. And what I'll say is, in this conversation, I'm really gonna just speak to very, very general principles, because it's a fairly detailed art, if you will, to figure out the most optimal solutions. But suffice to say, the information is out there, but the level of awareness that I find among consumers I speak to at all socioeconomic levels about the value of Social Security is remarkable. So I asked a gentleman that he actually runs the investment banking division of a fairly large financial institution. And I asked him to estimate what he thought his Social Security benefit was worth. And I think he estimated, PV of $50,000 or $100,000, something like that. And again, that's assuming that we all get what we're promised, right? So I'm going to take that as a given. But and I said, well, no, it's I don't know exactly what your number is, but assuming you've been paid as well as you've probably been paid for your entire career. This is a guy that was probably in his 40s. I said, by the time you're 65, the PV today, assuming you work the full number of years and you get the full benefit and everything else like that, but the PV of that, of your Social Security benefit is in the many hundreds of thousands. It's certainly not 50 or 100,000. It's quite a bit larger. So there's lack of awareness about what the value is. There's lack of awareness about how to maximize that value. And I'm fascinated by it because in addition to being able to help people create some real change in their net worth, it doesn't feel like net worth, but effectively it is. They're able to we're able to sort of give them some real value, and we were able to educate them about what an annuity is and what a pension is, all at once. And the last piece that I actually neglected to mention, which is a shame because my specialty is effectively longevity, is that this is a benefit that pays you till you die. So you've got this benefit that is inflation adjusted, that pays you as long as you live and is backed by the U.S. government. Minus some political risk, which may be which may ultimately be quite meaningful, but we can't say how much. There is real value in evaluating it. And what's striking is once you tell people what it's worth, it's not just the mass affluent that want to know how to maximize the value. People that have real wealth want to know the answer too, because it as a single asset, it's significant.
So yeah, Ramsey, I think all of that is amazing information. And what it really makes me think about is what you were saying earlier to me about just how people receive investment advice, especially after the pandemic, how that's changed. I mean, we're talking about receiving retirement advice. Talk to me about how that's changed, what the pandemic has done to how we receive that advice.
Sure. So I'm going to do that in two parts. First part is that the advent of COVID has accelerated remote advising in a way that I think is very positive. So there's a lot more willingness from consumers to receive their advice over Zoom, and there are a lot of advisors and agents that are learning how to do that. Unfortunately, there are a lot of others that are sort of struggling with how to do it. So there are going to be winners and losers from that process. I think that in the end, the consumer wins. I think that that having the flexibility to do things remotely as well as in person, when and where appropriate, is better overall for the industry. So I would like to see as much of it as possible. Now, on the path to getting there, the question is like, well, what are some of the impediments? So we actually put an interesting poll up on our LinkedIn page this past week. And it was about a topic that I think is actually, I'm surprised it isn't talked about more. And it goes as follows. And I'll read the question. The poll question was, as the nationwide vaccine rollout unfolds, business conducted in person may increase. Is it appropriate to say you are fully vaccinated on your LinkedIn profile? And the question was inspired by one, this sort of gravitational pullback to more in person. Again, I think remote advising will be bigger than it used to be, but in person will happen. And then also sort of seeing what's happening in other countries like Israel, where once you get vaccinated, you have a passport, which means that you can go some places that people that aren't vaccinated can go, and what that all means. And obviously, it's something that can be politicized, and there's all sorts of potential issues there. But it's also a business. It's just a straight business issue. So there were 4 potential answers to the question. So is it appropriate to say you're fully vaccinated on your LinkedIn profile? First choice was yes, it's totally appropriate. 37% said yes to that. The next one was yes, it's a competitive advantage. So the somewhat utilitarian Machiavellian approach. 8% said that. The third answer was no, not appropriate. 40% said that. And the last one was no, total blank move. And you can fill in the blank as you see fit. And 15% said that. So 55% said no, 45% yes. And but the really interesting things came out in the comments, and they obviously reflected both sides. But there were some people that came up with creative ideas like, yes, it's okay, but don't put it front and center. Don't brag about it. Put it somewhere in your profile where if somebody wants to meet with you, they can find it and they know they can meet safely. And again, lots of other comments all over the map. But that to me was actually the best sort of, in my view, the best middle ground. I think that this is a topic as more people get vaccinated, this is going to be talked about more because there will be some sort of separation, right? Some people will take meetings and do things in person and some won't. Some people will want to know, should you have an ID? Should you bring your card? What does all that mean? I think that's going to be a real topic. And I'm just surprised it hasn't come up more yet.
Yeah, I think that is a very important point. And, I don't know how many months we are to being there, but who knows, within the next half year, next 6 months, everything that you're talking about will become a reality and people will want to know, what that reality is. So great conversation, Ramsey. I really appreciate you coming on the show. And let's see what people said to your thinking about Bitcoin and crypto in the comments as well.
Right. Hey, you know what? I've always been fascinated by it, and I'm more focused on it than ever.
Excellent. Well, right. we'll have to pick your brain on that at some point.
All right.